You know that feeling when someone shows up for you just when you need it most? That's what Uber is all about. Not just a ride or dinner at your door. It's how Uber helps you show up for the moments that matter. Because showing up can turn a tough day around or make a good one even better. Whatever it is, big or small, Uber is on the way. So you can be on yours. Uber, on our way.
Reality radio for a really great future. We're talking real money.
Well, hello again. Welcome to the show about your dough, and it gets more and more important to talk about money and real investing by the day. I'm Don McDonald. Over there's Tom Cock. This is Talking Real Money. We're truly here to help you gain perspective and avoid doing some really foolish things in these weird and scary times. Our number is 855-935-TALK. That's 855-935-8255. And we know it's scary. We know it feels strange. We know we're out of sorts and the markets are out of sorts and you're worried about your job and where your next paycheck's going to come from and what's going to happen tomorrow. So we're here to try to talk about the financial part of that, which is crucial. You hear all day long people talking about the health part of it, and you know what to do. You know what to do about that. But the money part, it's hard to know what to do. We have some pretty solid answers based on real solid science, and we want to share those with you. So give us a call at 855-935-TALK, 855-935-8255.
You got to know when to hold 'em.
Oh, gee.
Know when to...
No, stop. Ow.
I know. Well, your song last week was worse than mine, so... But,
okay, may have been. I don't remember what my stupid song was.
And neither does anyone else, thankfully. But
which is for the best.
That's a reference. Kenny Rogers passing away yesterday, of course, and you sitting there...
I just don't understand the context.
Know when to hold them, know when to fold them. I mean, we're right in the middle of that. What's wrong with you? You're throwing the money in or saying,
you're not going to encourage people to fold.
No, I'm not.
You're not encouraging people to fold them, are you?
But other people are. I'm not. I'm certainly not. No,
don't watch CNBC.
As you know, we're suggesting you sell the things that have gone up and buy the things that have gone down. That's what we're doing. I mean, that's what we're doing for our clients. And we had a couple of webinars last week. You did a great one yesterday. And our friends at Dimensional Funds did one a couple of days before that and really helped people understand that that's what makes sense.
And I have a brand new, because the response was so great. And a lot of people said, are you going to do another one of these so I can tell my friends? And so I have scheduled a new one. And no fooling. It's for April Fools.
Yeah, I saw the date. Yeah, it's good.
Yeah, we're not fooling around on April Fool's Day.
I don't know that you can do a financial webinar on April 1st, but yeah, all right.
I can too. Okay. I'm doing one.
All right, we're going to add in a couple of more things to it too. So just for people to kind of
great. You're going to make it longer now.
Well, because one of the things people always say is you tell us, well, don't sell your stocks because they went down. We'll spend more time on that. You say you got to have a plan so you don't respond to market conditions. What's the plan? So we'll spend a little, because you did a great job yesterday talking about what happens after one of these shock, bear markets, whatever, and what happens the next 1, 3, 5 years. I think it's very valuable. And when you step back and look at all this, we've got some great stuff from Jason Zweig today to talk about. But how do you put together that plan so that you don't look at your money every day? You don't respond to the media or the next thing that comes on the news about the coronavirus. So we'll add that in, just a little touch to the April 1st.
One of the keys to getting started in the right direction toward that plan, though, something that apparently most people don't seem to know. And that's what is your risk tolerance? How much risk can you really stand? Apparently way too many people were invested beyond their tolerance for risk. If you're freaking out and panicking right now, you really didn't know your risk tolerance, did you?
Well, there's two parts to this one, right? I mean, in 2008, clearly that was the financial crisis. Here, you've got the health thing added on. So you're probably scared, even though we know what to do, you're right, but we're still like, what happens when somebody I know gets this? Or all these sort of what ifs that are out there that I think are making this worse.
But remember, back in 1998, and this goes to Jason Zweig's article, by the way. Back in 1998, there were multiple headlines. Time Magazine read one, Fortune Magazine read one. The Fortune Magazine was the crash of 98. Can the U.S. economy hold up? Do you remember the crash of 98?
I do, because I remember the Asian contagion, but
Yeah,
I do
but
know what
most
came
people-
next.
Most people don't know. They don't even remember. They're going, what? There was a crash in 98? I remember 2000.
Well, we could,
But the
and
one
we
in
could spend a
98
little.
was caused by a virus.
It was indeed. And we could spend a little time talking about the economy and the stock market, by the way, because as you know, generally the stock market is a leading indicator. Market does
Yes.
something and the economy falls. Not always, though. Our friend Larry Swedger did a brand new webinar that I just watched this morning where he correctly points out that coming out of 2008, 2009, and I'd forgotten this, you had a decade of no growth above 3%. I mean, generally, when you come out of a deep recession, you get growth of the economy greater than 3% a year. Not one
we're talking
year.
about economic
I'm
growth.
getting to that,
Yeah,
yes. And
yeah.
So then if they asked you in 2009, is that a good time to buy stocks? You'd be like, well, no, because the economy's not growing very fast. And yet we had a 10-year, absolutely almost record-breaking bull market. So they're not always in lockstep, but you can see some causal inference there generally.
The stock market, rather than being a leading indicator, it's more of an anticipatory marketplace. It is a place where I believe, and I think this has been shown pretty consistently, that the traders, and I hate using the word investors when it applies to the people who are playing the market day to day, they're traders. They factor in what they perceive at that moment to be the absolute worst case scenario from whatever the current event is. So right now, the reason you're seeing the stock market down about 30% globally is because traders around the world are saying, well, if it gets as bad as the worst case, this is what stocks are worth. So in a scenario where we don't have the worst case, where we have a medium or better than medium case, then you're going to, at some point, while things seem bad, you're going to have a bounce in stocks, and everybody's going to be calling us going, well, why is the stock market going up? The news is terrible.
But even if it is that bad, you hit the right chord earlier. Well, I hit the really good chord with the know when to hold
With
them
the
and fold
song?
them. I
Yeah,
got that.
yeah,
But
yeah.
the right chord is this fits into your overall plan because you have to take volatility. You have to bear the uncertainty of stock market prices to get the returns, or you simply put it all in the mattress, which apparently a lot of people are doing right now. Because they're not even going to gold.
they're not buying anything.
They're not going to gold. They're not going to Bitcoin. All these things are going to be so safe when the next crisis came. We'll talk about that. But your plan should allow for these sort of volatility. That's the key part.
Rarely do we have this much stuff to talk about and these many concerns to assuage. So let us help you do that. Call us at 855-935-TALK, 855-935-8255, because we are here to help you make smarter money decisions.
Tom and Don are talking real money.
If you're worried about your investment portfolio in this turbulent market, you may not have the right portfolio. A long bull market makes investing seem easy. We get complacent and start believing that stock prices always go up. They don't. They can't. If the value of stocks always rose, they wouldn't be risky, and if they weren't risky, there would be little return. Markets like the ones we've experienced are the price we pay for potentially high returns. Yet, you must be able to stay properly invested during downturns. That's why it's critical you have the right portfolio for your risk profile. So, before you do something you may regret, join me for a special free online class, Retirement Investing in Turbulent Times. Reserve your place now at TalkingRealMoney.com. I'll show you the scientific evidence from past market declines, how to determine your risk profile, and build a simple no-load portfolio based on your personal needs and fears. Sign up now at TalkingRealMoney.com. That's TalkingRealMoney.com. And if you're listening to this podcast months after the crisis, well, take a look. We probably have some other great classes you can sign up for at TalkingRealMoney.com.
For your real life and real future, Tom and Don are talking real money.
And if you don't want to be fooled on April Fool's Day, but you do want to attend my next class, which is Retirement Investing in Turbulent Times, go to talkingrealmoney.com. It's up there. You can sign up. It's free.
Special guest appearance by yours truly as well.
Did we decide we were going to let you go?
Just doing that anyway, so we didn't decide.
We'll see. Maybe it won't work. I don't know.
Knowing me, since I had the echo chamber for the first one, who knows? Wow, that was bad.
Hey, our phone number here is 855-935-TALK. If you need some money help, some financial advice, a little calming, give us a call, 855-935-8255. And Perry, it's your turn. Welcome to Talking Real Money.
Hi, Perry.
Hi, gentlemen. I love your show. I just have a question. I've got a balanced portfolio based on my risk tolerance. I've taken your quiz some time ago, and I have a question about the conservative part of it. So, I have part of the portfolio in the market through Vanguard funds like you recommend, but on the conservative part of it, I've got some of it in Treasury bill fund. I've got some of it in FDIC guaranteed bank deposits, and I've got some of it in a stable value fund. My question is, how risky is the stable value fund given that, it's insured? Well, it's not insured by FDIC, but it's the underlying assets, I believe, are like corporate debt, and it does have insurance. The insurers are MetLife, Voya.
Yeah, well, I'm going to stop you there because you're exactly right. A stable value fund is made up of a thing called guaranteed insurance contracts, GICs. And the insurance company takes the money in and then says, aha, here's an easy way to make 6% on your money and only pay you 3%. They've been doing it for a long time. Boeing. Should we talk about Boeing? Boeing.
Don't jinx it.
Well, we still can. Boeing's stable value fund has been a very fine fund in their VIP for many, many years. You're right, though. Is there a concern? Is there a worry that what if all those contracts they have, they're unable to meet those obligations? This is why, for example, in the money that we recommend you use short term, we would be recommending it's short term U.S. government debt, which, by the way, corporate debt's had a lot of trouble this year. We can talk about that later. But the DFIGX, the Dimensional Intermediate Government Bond Fund, is up just a shade shy of 7%. So does a stable value fund make me nervous? A bit for the underlying assets, but if you look at the long haul, it's done very well. Don?
Yeah, and you hit on the most important point that everyone should be thinking about all the time, not just in markets like this. This whole business of saying an insurance company is guaranteed or that their underlying bonds, basically these contracts, are guaranteed. They're only guaranteed as long as the insurance company stays in business. If there was a massive failure, for example, like AIG almost failed in 2008, if AIG had failed, we would have seen state insurance pools dry up. They would have run out of money, and you would have seen the folks who had these GICs and the like, you would have seen those folks in trouble and probably getting payouts extended from months to years and years to get that money back. So there is it's an ironclad rule that we all need to follow, even though we don't like it. We don't like it at all. And that is, the higher the return on a vehicle, the higher the risk is somewhere. You may not know where it is, but it's there somewhere. There is some sort of inherent risk, or you wouldn't be getting those higher returns.
And the only riskless return I really know of to date is T-bills, very short-term government debt, which I think
don't fluctuate.
Yeah, and it's paying less than inflation. I mean, so you're not really
quite a bit.
Yeah,
less
I was going to say
inflation.
maybe I don't know what it would be today, but in other words,
let me look at what the T-bill rate is right now.
So Perry, do I think you should worry? No. Would I run out and buy stable value fund? No, I'd rather own U.S. government short and intermediate term debt instead. Thank you for your call. Great one.
Thank you. Appreciate it. 855-935-TALK is our number. TJ, you're up next. Welcome to Talking Real Money.
Hi, how are you?
Hello.
Good. Thank you for having me on. So you may have gotten this question, but I'm going to ask it anyway. So basically, for my retirement. I have a pension and I'll have Social Security. And then I have a little bit in the Vanguard account. I've got 60% in the Vanguard Total World Stock, and I've got 40% in the Vanguard Total Bond Market. And I'm thinking this might be a good time to take some of that bond money and put it over and buy some more in the world stock.
Yay! You win the gold star. You win the free Thanksgiving turkey or whatever we can give away. Can we do that anymore?
Wow.
This is exactly the right thing to be saying. This is exactly the right type of behavior that will, over time, do two things. Number one, it will make you more money because you're selling the things that have gone up and buying the things that have gone down. Number two, it'll actually reduce risk, because if you just let things get kind of hairy, out of control, generally, by the way, it's stocks you're selling and bonds you're buying, but in this case, it's not. You're selling bonds, as you correctly point out, and buying stocks. Your behavior is absolutely 100% spot on. Don?
Yep.
Well, man, a few words. That's a new one.
Yep, I totally agree.
Yeah.
This is the time to be that's part of the discipline of investing. You keep your balance. Whatever portfolio balance is right for your risk need and risk tolerance is the one that you need to maintain. And when you get about 5% out of balance, it's time to rebalance and sell those things that are now the bigger portion of your portfolio and buy the things that are the smaller portion. And by the way, the 30-day T-bill rate
what is it right now? What is it?
0.1%.
Wow. Okay, so pardon me about the inflation thing.
1/10 of 1%. Just a couple of days ago, it was 1/4%.
Yeah, I mean,
that's how far it's fallen.
And we'll spend a little time during the program today talking about fixed income investment. It's been a wild and wacky world for bonds because for a variety of reasons. Corporate bonds, there's now worries about defaults there. Even municipal bonds, people have been kind of freaked out. So we'll spend a couple minutes on that. But I want to finish the thought.
Wait, March 20th. I am so sorry. I was looking at the March 17th rate.
Oh, what is it now?
I'm sorry. The March 20th rate. That was March 17th. The March 20th rate is 0.04%.
Okay, so you can put
in essence, zero.
You can put your money there, and you wake up tomorrow, your money will still be there.
That's all.
Yeah, not a dime. Well, almost not a dime more.
And what was it a year ago? This is fascinating. I just love this. 1 year ago, back in, I take that back. 1 month ago, February 20th. It's 1 month ago.
Yeah.
1.6.
Wow. So it's come down. That's dramatic.
That's
for T-bills?
Huge.
Yeah, that really is. So there's a lot of things going on right now with the fixed income markets because somebody called us the other day about municipal bonds, and I don't want to dive too far into that. But
let's not go into
but I think one thing we could discuss on the show is the difference clearly defined now between U.S. government bonds and crummy corporate debt. That's something to discuss.
Yeah. That is a topic. And now, again, it's going to come back to haunt people. They're going, I was getting into something safe. Getting a higher yield and safety? That doesn't work. 855-935-TALK.
Tom and Don are talking real money.
Do you know what your investment risk tolerance is? Take our free no-obligation risk quiz at talkingrealmoney.com.
Your guides to a really great financial future. Tom and Don are talking real money.
Well, at least we still have radio. Actually, after a while, I get tired of watching television. I'd be telling my smart speaker, I'd be going, hey, Siri, tune on KOMO. You have to say KOMO, not Como. Don't say Como.
Yeah, right.
It gets them confused. But what's funny is when you say play KOMO, it says playing Como radio. And I go, well, you knew what it was, apparently, because you said it. But
to TV, just for a moment before we go to Ed, is it me or they're just putting a lot more sort of first-run films up available for rent and stuff? Oh, my
gosh. The Invisible Man that just came out is going up streaming. The new Pixar movie is available to rent and will be available to stream in like 2 weeks for free.
I watched the biopic. I think this is about your previous career, Uncut Gems with Adam Sandler. I watched that last night.
I was a gem
really
cutter.
Good. Yeah, you're really good, man. A little nervous about the betting thing, but okay.
What I watched last week tonight, the final episode. Do you know it really is important for a comedian to have a live audience?
It really is
the
tough.
show without an audience, and I mean, it was not very funny.
Yeah, well, I know the feeling.
The
I
audience
do it every
helps.
night without one, and it's not an easy thing.
I mean, look at us. We're not getting any live laughs.
Exactly.
We have no
Stacy
laugh
smiles
track.
every once in a while.
Every once in a while.
Modestly.
But it takes a lot to get her to smile.
Yeah,
And
that's
who can
true.
blame her? She has to work with you every Saturday.
Indeed.
855-935-TALK is our number. Did that get a smile from anyone? Ed, you're up next. Welcome to Talking Real Money.
Hi, Ed.
Yes, hello. Hey, I've been watching a lot of Gunsmoke.
Ed, you're showing your age there, but okay.
Good guy always wins. Hey, I'm 77.
Marshall Dillon.
Marshall. Yeah, go ahead, Ed.
Very diversified American funds. In January I had 750,000 in there. Now I got 560. I'm a retired educator. I have Social Security. I have no debt. I own my own house free and clear, and I haven't even had to touch except for minimum distribution on my American funds. And about 10 years ago, was down to about 400,000. I pulled it out for about 5 months, and then I put it back in, and it took off. And I'm wondering right now if, having lost in value about $200,000 almost, if I should, and I'm not putting any more money into it, I've just let it ride. My risk tolerance is, as I get a little older, I'm thinking, well, I really don't need this right now, but it would be something to give to the family, of course. And anyway,
You said the operative word there, Ed. Go ahead, Don.
Well, you said a couple of operative things.
Mm-hmm.
Let me start with the most operative of the words, and you said having lost. Remember, the loss you have, you already have it. So let's say you sell. When do you get back in?
Yeah. Well, I did it before.
No, really.
I thought I did okay, but I don't know if it would make sense.
We are down 30%.
Just hang on.
Yep.
Yeah, 30% is in line with some of the worst markets we've ever seen.
We're number
We don't know
10,
if this
by
is
the way, with a
end.
bullet.
We're number 10 with a bullet.
Exactly.
But the other thing you said, though, that is very important is that you don't need it. It's a windfall for the kids.
And can I ask something? Is this all in stock mutual funds?
Oh, it's diversified, and I don't have my account numbers right handy here, but there's about 10 of them that I have. It's all...
I got to tell you,
funds,
Ed, I am
well.
pretty confident it is not well diversified, just from how big a loss you mentioned. It sounds to me with a loss like that, you may have a lot of American funds, but I got to tell you, as one who knows American funds very well, I was an old stockbroker selling them years ago. If you own a bunch of American funds, you pretty much own the same thing over and over and over again. They may have different names, but they're almost identical portfolios
American Fund
in
of
most
America,
cases.
et cetera, et cetera.
They just look the same. And it doesn't sound to me like you have a well-balanced, properly planned portfolio for your risk tolerance and your risk need. You don't need to take risk. You shouldn't have been taking risk. If you have a stockbroker who's telling you to do this, you have a bad broker. This is just someone who's giving you horrible advice. And I mean horrible advice. This is somebody I'd fire right away because, one, you said you don't need it, so you don't need to take risk. Two, because it doesn't sound like it's in any way, shape, or form well diversified. Doesn't sound like you have government bond funds in there, for example. I would really look to someone who is a fiduciary, 100% fiduciary, and the person you have isn't.
Tom and Don are talking real money.
Download the advisor interview form and find out if your advisor's a fiduciary at talkingrealmoney.com.
Reality radio for a really great future. We're talking real money.
You know, NBC ought to bring back Fear Factor Coronavirus Edition.
Dig real close in there and do that.
People in their homes going, I don't want to go out. People looking at the stock. Oh, no, I can't take it anymore. People buying bonds.
People moving to
not buying
cash.
bonds.
People not even buying gold. You know what they are buying? You know this already. They're buying guns. Gun sales are way up. Yes, gun sales are way up.
May I just say this one more time?
Go ahead.
One more time. You guys, those of you who are doing that, you've watched way too many survival shows or Walking Dead. You just, no, this is not the zombie apocalypse.
Or they're
It's
like
not.
Ed, they're watching Gunsmoke, and the good guy always wins, he said. So I want to be the good guy.
I haven't watched Gunsmoke since I was a small little lad.
I don't think it's been on since you were a small lad.
I don't think so either. And you know, I have gone back to look at some of the old shows
to see what you would
watch. And I'm sorry, they're not very good.
Well, no, the writing today is just, no offense to those people writing in the 50s and 60s, but yeah. Well, leave it to Beaver. I guess I could watch that again, maybe. So.
Only because you're so much like Eddie Haskell. 855-935-TALK is our phone number.
Sadly true, probably.
935-8255. If you've got a money question, we're here to give you we'll give you serious answers.
We will.
Although we will try to lighten up life because you can't sit around moping all the time, and you can't.
No, you actually you can, but you shouldn't.
But you shouldn't, and you really can't. You've got to stop. Do not turn on CNBC.
That's the worst thing you can do. Watching this moment to moment. By the way, one of the things people often mistake about investing is when stocks go down, bonds go up. There is no such, there's no track record of that offsetting each other. Sometimes that happens, but there is.
Sometimes it happens, but there is no direct correlation.
No, there is no correlation.
The reason we put bonds in portfolios is not because they don't correlate, but because they tend to be, and they have been, by the way, high quality, short intermediate governments have been very stable. Those bonds have been stable.
And they worked in 2008, 2009. And they're working,
they're working today.
Right. They're holding their value. They're making a little bit. As I mentioned earlier, intermediate term bond fund operated by dimensional funds up 6.7% year to date. But so many of you over the last few years would call us and say, well, I don't want to be in those bonds because they're only making, 2% a year. I want to be in bond funds that are going to make me some real money, Tom. Okay. Well, that's great. So you went out and bought, these things they call high yield bonds.
High yield, yeah. One of my favorite twists to it.
Yeah, it's bad. I mean, those are junk bonds. I mean, well, you can give the numbers, but the BBs and lower, et cetera. But okay, so let's just say you did that, right? And you did it because you wanted to make money. Well, there's another side to those bonds because at times it looks like those corporations, and boy, if there's ever a time, apparently everybody in Washington except you and I are back there with their hand out, by the way. We got to, one of the two of us needs to go there because everybody else is saying, give me some of this, give me some of the $2 trillion.
Oh, yeah, we haven't even gotten to the senators. We haven't even gotten to the senators
yet. That's a whole other thing. But so if you own intermediate term government debt, that's done what it's supposed to do. As I said, it's made some money this year. If you owned because you had to make something on your bonds. Again, this is another fallacy I think about bonds. I don't want to have part of my portfolio that's not making money. Well, that's great. You went into the Vanguard High Yield Bond Fund, which is VWEHX. That has declined 17% year to date. So that's not bond-like performance that we want for you. We want bonds to hold the value and make the money with stocks. The reason, as I just mentioned, that these bonds have had a very tough time is they're issued by corporations that may or may not have the resources, frankly, to pay you back, may or may not have the resources to hang in there for whatever period this is, with or without the help of the government. I mean, you're looking at some very fine corporations. We laughingly referred to Boeing earlier, but I mean, Boeing is back there with its hand out at $60 billion or whatever it is for Boeing and its suppliers because they're saying they can't come up with the capital. Don't buy bonds to make money. That's the bottom line. Buy bonds to hold the money.
And I want to make an interesting comparison. Let's skip the junk bonds for a minute because most people, even though we get greedy, we know that if we're buying into a high yield bond fund, we are taking risk. However, we may think that if I'm not saying this is a bad investment to make, but for example, Vanguard has two different intermediate term bond funds.
Yes.
One is the intermediate bond index. The other is the intermediate treasury. Now, the intermediate treasury is 100% in treasury securities, U.S. government obligations. Its year-to-date return, 6%. The other fund, the bond that has corporate in it, its return has been slightly negative. You see, the risk is higher in those corporate bonds. 855-935-TALK is our number. We'll help you make money make more sense.
Tom and Don are talking real money.
Just about everything you need to know about money can be found at our website, talkingrealmoney.com.
For your real life and real future, Tom and Don are talking real money.
Sound like my house, like my wife. Keep your distance.
Keep your distance,
Yeah.
but that's all the time at your house.
It's funny
That's
the way
not
she
just
said
during
that.
this. It's like,
Exactly.
just stay away.
Keep your distance.
Go upstairs.
Exactly.
Where don't you have an office over there?
Exactly.
Go over
Hi.
there.
Yeah.
And speaking of the keep your distance thing, I noticed a bit of hypocrisy in our government. I was glancing at the TV earlier before the show when they had the presidential press thing that they do every day now. And why do all these idiots like Ben Carson hover in the background about a foot away from whoever's speaking so I can get in the camera?
No, so
They're
you can make
not-
for a great skit on Saturday Night Live. That's why.
But they're not social distancing. They are not.
That's weird.
Bad example. Anyway, I want to go back to the bonds for a minute. I'm
Yes.
Don. That's Tom. This is Talking Real Money. I want to give you the phone number, 855-935-TALK, 855-935-8255. Now,
Before you go into it, can we just say what a bond is versus what a stock is?
a bond is something that's really sticky that makes two things stay together. It's a bond.
A bond is something you and I have had for over 30 years.
We've had for and despite our sniping at each other, we still have it.
So a bond is an
I don't know
IOU, this is a piece of paper that says a government or a corporation going to pay you, give you your money back with interest.
Mm-hmm.
A stock has no such guarantee. There's no comparison. Stock is ownership in companies. So you really need to be careful about the difference between the two. Don?
But the comparison, though, is the similarity between stock and corporate bonds.
True.
Is that they rely on the health of the underlying corporation. A stockholder, a shareholder, is going to get wiped out before a bondholder, but bondholders can still lose some of their money, and they're more volatile. And this is what I wanted to, the point I think is, this is such an important point about there's BC and AC, before Corona and after Corona. If 6 months ago I had said, here are two intermediate term bond funds with similar durations, they're both intermediate, and you can have a choice between a yield of 1.74% or 1.04%.
Duration refers to how long until you get your money back.
Till the bonds mature.
Right.
And if I'd shown you these two funds side by side, one of them being the intermediate term bond index, which is treasuries and corporates,
it's a
the other
5 to
being
8
the
years.
intermediate term treasury only, no corporates in it.
Yeah.
And you'd look at that and you go, hey, those corporate bonds are okay. I'll take the 1.74 for the higher yield. Well, that's the current yields on these two. The Treasury is 1.04. The intermediate term bond index is 1.74. But the difference in return year to date is the difference between 6% and negative 0.2%.
So 6% for the Treasury, obviously, and negative 0.2 for the one that includes the corporates. Yeah.
So
I think
for people who are asking why aren't bonds going up? No, bonds are going up. Just not the ones you own.
First of all, nothing is going anywhere, as you know. It's gone. It's gone.
Yeah.
And by the way, the other fund that we recommend on this program regularly, the Vanguard Total Bond Market, VBMFX, that's about broken even for the year. So, because it has, I think, 70% governments, maybe 30% corporate, so it does hold some corporate debt. But I think over the long haul, that's a pretty generally safe place to be. I haven't looked at the volatility of that fund to see how the ups and downs. I mean, the bond market has been fluctuating wildly the last few weeks. It has been a bit of a concern, and there's a lot of concern, as I said, about whether or not a lot of these companies are going to be able to meet their obligations. No one really knows.
And this also goes to that strategy that was all the rage, BC, not AC, but BC.
Yeah.
When everyone we got lots of calls about this. Well, why don't I just buy a dividend paying fund?
Yeah.
Well, these companies had good dividends. They've been paying them forever. Yeah, they pay them.
Never a problem.
Right up until they don't.
Mm-hmm. How's the
do?
dividend paying funds doing? I haven't looked any up to see.
I haven't either.
What that's doing. And of course, one of the disadvantages you face when you buy a fund that is really only owns dividend paying stocks is you're reducing your diversification, because I think it's like half of the stocks in the United States pay a dividend. The other half do not. They either reinvest the money or they keep it, etc. So I can see this is not not looking good here, obviously.
Well, they were running pretty high dividends on these things. A couple of percentage points. Apparently, the dividends are already threatened. The fund, the Vanguard, and we're using Vanguard. I could find worse.
Oh yeah, we could.
Because
you could find nice ones that are where they're charging you 1.5% for the pleasure of owning them.
The Vanguard Dividend Growth Fund is down 27% year to date.
There you go. Does that sound like a safe strategy?
That's not safe.
No, it's not.
No. And the yield's only 1.94. So you got a yield that is comparable to the Vanguard Total Bond Index Fund, which is 1.84.
Yep.
The Vanguard Total Bond Index Fund is flat. It's 0.22 up. So it's flat. But
you're right. That's it down. Yeah, it is 2.2.
It's 0.22 up. Yeah.
Mm-hmm. Not much.
So if you're worried, see, the problem we run into as investors is and this is something we're going to come to a little later in the show, the next hour probably, we tend to take whatever we're experiencing at the time and project that going forward ad infinitum. So now you're looking at the stock market and going,
it's never going to end. It's called recency bias.
And a year ago, you were thinking it would always be good.
I think it applies to other parts of your life, by the way. My 12-year-old daughter, I would have said she would never clean a room. Ever.
What?
Because she never had cleaned it. Well, last night, I was going to bed at like 10 o'clock last night, which is, as you know, late for me. I popped my in there to say goodbye, good night. And she was
goodbye, dear. Dad's over 60, so I got to tell you, with this coronavirus thing going on, I could be gone by the time you get up.
She's using that for a reason not to hug me, but she had. This is serious. I'm not talking clean your room like make your bed, that kind. She had all of her drawers out, everything out of them on the. I said, "What are you doing?" She goes, I'm cleaning up. I'm cleaning everything up. So apparently we've reached the place now where I've been locked in the house for a week. I got to clean. Anyway, it's fascinating.
I'm so bored.
So my recency bias saying she will never clean her room. See, I was wrong as well. So.
Oh, and speaking of Tom's home life, I just want to add one thing.
Uh-oh.
Yes, I do. Yes, I want to say this. Many of you know that Tom's wife, Danielle, has a wonderful pizza.
Oh, okay. That's where we're going. I was nervous. You had me going.
Pompeii wood-fired pizza. And by the way, I sit around here. I'm at my Virginia studio right now. Yes. I sit around here craving it like nightly, but it's 3,000 miles away. It is such good pizza. But anyway, Tom and Danielle last night set up their pizza truck in their driveway and fired it up to 900 degrees and served their whole neighborhood socially distanced pizzas.
Yeah.
Which is really,
this
is the kind of thing people should be doing.
Oh,
this is a wonderful kind of thing to do to get through stuff like this, something special like that. And I got to tell you, I'm very impressed that you guys did something like that.
Oh, thank you. It's very kind.
And I'm sure your neighbors are
they've been sending us nice texts all day. And interesting, by the way, the interesting thing that came out of that, some people stopped at the driveway. They're like, hi, you got to come closer to get the pizza. I don't know, what are you going to throw it?
By the way, we're outdoors.
Exactly.
We're outdoors.
But the young people, anybody under about 35, I noticed they just came up and hung. I guess nothing's going to happen to you if you're 30 years old or whatever. So.
Have you seen the pictures of beaches in Florida during spring break?
Fascinating.
Body to body. They just can't get enough of each other. But they're in their 20s. They're young and they have bodies to be next to bodies,
exactly.
Unlike us.
Yeah.
So, we're going to take a quick break. 855-935-TALK is our number, 855-935-8255. Let's talk about your money and your life.
Tom and Don are talking real money.
If you're worried about your investment portfolio in this turbulent market, you may not have the right portfolio. A long bull market makes investing seem easy. We get complacent and start believing that stock prices always go up. They don't. They can't. If the value of stocks always rose, they wouldn't be risky, and if they weren't risky, there would be little return. Markets like the ones we've experienced are the price we pay for potentially high returns. Yet, you must be able to stay properly invested during downturns. That's why it's critical you have the right portfolio for your risk profile. So, before you do something you may regret, join me for a special free online class, Retirement Investing in Turbulent Times. Reserve your place now at talkingrealmoney.com. TalkingRealMoney.com. I'll show you the scientific evidence from past market declines, how to determine your risk profile, and build a simple no-load portfolio based on your personal needs and fears. Sign up now at TalkingRealMoney.com. That's TalkingRealMoney.com. And if you're listening to this podcast months after the crisis, well, take a look. We probably have some other great classes you can sign up for at TalkingRealMoney.com.
We hope you realize that the information provided on Talking Real Money is for educational and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately, consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Vestry, a fee-only registered investment advisor. Thanks for listening, and please visit TalkingRealMoney.com for more information and disclosures. That should keep the lawyers happy.